Hello, beautiful people. It's Keith here from Performante. Today is January 14th, 2022, and in this video, we'll be going over why we think the economic crash is further away than you think. And this would be related with stock markets, if you're invested in the NASDAQ, tech stocks, even if you're a value investor, all the way to if you are investing in crypto, if you're a DeFi degen, all the stuff will be impacting you. You may not think that, for example, interest rates or US bonds may be impacting you, but it definitely is when you're looking at it from a very 10,000 feet in the sky type of view. So before we get started, just want to brush up on one thing here. If you are watching this for the first time, my name is Keith, and I'd love to welcome you to Performante Community Culture. We have created a community of like-minded crypto enthusiasts, from all walks of life, sharing trade ideas, new projects, updates on existing projects, and that's really just scratching the surface. Discord is our home, so if you're interested in crypto, it's really the place to be. We also created a social token called PCC along our journey, and you can earn it all for free right from our Discord. Digital assets and a great community. Link is in our bio. And before we dive in, just want to say that we are not financial advisors, and this information is not financial advice. It's just really to consolidate the information into a single video to help with the due diligence process so you can make an informed decision about what the Fed might do and how it may impact the overall markets. So let's jump right into it. First thing that we want to discuss is the interest rates that printed. It was at 7%. And for those that may not know, what this is basically a percentage difference from December 2020 in terms of the basket of goods and services that the consumer price index is calculating, and the change of those goods and services from 2020 to 2021, both looking at December. And for this current December, from 2020 to 2021, we saw a change in price of 7% to the upside. So we're seeing an inflation of 7%. Keep in mind that CPI does change in terms of the calculation quite frequently. So some CPI numbers that you saw way back when is not actually counting the same basket of goods and services that we're seeing right now within the CPI. And when you're looking at it from a very large time frame, yes, we did see a little bit of inflationary worry in like 2007 area, but we really haven't seen an inflation rate of around, let's say, plus 6.57%-ish from until 1982. That was 1981, 1982 was the last point that we saw inflation this high. So this is really putting pressure on JPOW, central banks really around the world, because we are starting to see kind of the entire globe put on these zero interest rate policies or close to it, print lots of money. They're all in the same situation. They're all in the same boat. So really, I think they are going to be turning the tide kind of at the same point of view. So moving on back into the charts here, we are seeing interest rates significantly move to the upside. The next forecast for the FOMC meeting, which is happening on the, let's take a look here, I believe it's 16th, on the, so I guess the 12th, we can see that right here. That's for the forecast of 7.1%. The consensus is at 7, and the current actual is at 7%. So we'll see if it's actually going to move to 7.1. But what this really is representing is if we do see increasing inflation, this is adding pressure to the central bankers to do something. And what's that something that they're going to be doing? They've already been very transparent. What they're going to be doing is kind of two phases. The first phase is to reduce asset purchases in the open market. This is reducing stimulus injecting into an economy. If that doesn't work and we're still seeing inflation print higher and we're seeing supply chain issues still bottleneck things to make the prices higher and all that stuff, we're seeing this number go higher, the CPI and the inflation rate, then they'll have to go into phase 2, which is raising interest rates. But they do not want to raise interest rates. There is so much debt in the system that they do not want to raise interest rates, because governments will have to pay more, companies will have to pay more, any entity that has debt has to pay more. And when you're looking back at the last decade, think of how easy it would be to accumulate debt because the interest rates were so darn low, and the Federal Reserve knows that. Moving on to the interest rates, we can see they haven't raised them, and the consensus for this upcoming FOMC meeting might be on the 26th. is going to be, yet again, 0.25%. So the consensus, the forecast, sorry, states that there's going to be no change in the interest rates because the Fed has been pretty transparent and clear that right now they're in the process of reducing the open market asset purchases, and the next phase, the second phase, will be to actually raise interest rates, but they will leave that as a last resort in my personal view because they know it will tumble the stock market. This is a pretty interesting chart that I got from Tom Lee from Fundstrat. It shows the stock market returns in terms of I believe this is a 10-year rolling total, which is the bottom chart right here. So this is the return of the stock market on a decade-long basis. And then the top chart here is going to be, is the current environment a negative interest rate environment, or is it a positive negative real rate environment or a positive real rate environment? And how we get this is the inflation rate higher than the yields that the bonds are generating? And if inflation rate is higher, then we have negative real rates. If the interest rates are higher than the inflation rate, then we have actual rates that are providing a positive yield for investors. And we can see when we have negative real rates, which we indicated by these red markers right here, it's really great for risk on assets. This would involve really all stocks that are speculative, really. And then you have all of crypto. All would be basketed, in my view, as a risk on asset. So we can see this would be like dating all the way back pre-1900s, which is pretty crazy to see. But the most recent time that we had massive negative real rates was the, let's say, early to start of 1940s up until 1950s, almost 1960s, and that was a negative real rate period when it was the good times for the United States. There wasn't too much inflation. We were coming out of the war, like mid 40s, and obviously the West won, so they were really doing well in terms of the economic improvements that they were seeing. So that's why we saw a massive increase in the stock market. Things were economically well. We saw negative real rates. And from the economic standpoint, if you're an investor, if you have negative real rates in bonds, you're not going to really put any money in bonds because you're going to be losing money every single year due to the currency proliferation. So what do? You invest in more speculative assets, which would be like stocks, for example. And you're also looking at further future returns, because if you have bonds and they're paying for a yield, that's like basically a guaranteed yield that you would be getting. If there is no yield you'd be getting, you don't need much of a profit to actually make it worthwhile as an investment compared to bonds. So it is more all right, or investors are more accepting of higher, more riskier, or higher market cap, more riskier speculative investments, because it's still going to outcompete bonds because bonds are a negative real yield. So obviously, if you have more cash or more capital to park elsewhere, it's going to be really good for risk on assets and more speculative investments that might not get that cash flow or in that capital if it is a less euphoric time, would be another way to put it here. So really interesting chart right here. Right now, we are getting into the negative real rates territory. Obviously, with inflation at 7% and interest rates at 0.25, we're in a negative real rate environment right now. This particular chart is created on November 18th, 2021, so it is fairly updated. Obviously, not super updated, but still, it really shows just how important rates are to look at and how important rates are when looking at possible risk on investments. Because in my view, unless we're going to see interest rates increase, we will continue to see risk on assets to do well. That's really the underlying thesis of my kind of next 10 years or next 5 years, is really keeping an eye on what the Federal Reserve does, because that will be really dictating how I play the markets. This chart is pretty interesting as well. This is a dynamic yield curve. For those that don't know, this left chart right here, if you move this line right here, it will change this red line. And what this red line represents on the left here is the yields for different time duration bonds. So you can see on the very left is a 3-month bond, the U.S. government treasury bond, and then you have the 2-year bond, you have the 5-year, 7-year, 10-year, 20-year, and 30-year, and this red line here represents exactly what the yields were at that point in time. So on August 12th, 2011, the 3-month bond was at 0%, 10-year was at like 2.32, and the 20-year was, let's say, like 3% or something like that. So it gives you a really good understanding of how bonds react and the bond yields react depending on different market environments. And usually when we see bond yields invert, which we'll talk about in a minute here, that is when there is more uncertainty, fear, and worry coming from the bond market, which is smart money. You know, there's not a lot of retail looking at bonds, and the investors and the capital moving in and out of bonds is the smart money. It's the massive funds that are moving, let's say, a lot of money, to put it lightly. So we're going to be looking at how the bond markets act depending on the market environments. So this is the dot-com boom, this is the global financial crisis, this is COVID, and this is currently where we are right now. So taking kind of a look back at history, we can see that, you know, like a normal yield curve would be something like this all throughout like 2004, 5, 6. We can see that it's fairly on an angle where you have the shorter term bonds yield lower than the longer term bonds, which generally makes sense because if you're locking your capital up for longer, you expect to be paid a higher yield than an individual who's locking it for a shorter amount of time. Just kind of common logic in that sense. But when we see fear, uncertainty, and worry in the market, you see the yields for the shorter term bonds actually yield greater than the yields for the longer term bonds because the outlook in the longer term is not as favorable. So when we can see kind of close to the dot-com boom, we saw that the 2-year bond was higher in terms of the yield relative to the 5-year, 7-year, 10-year, 20-year, and 30-year. And that is really the definition of an inverted yield curve. And we can see soon after that, we had the dot-com bust, and then we rebuilt again with the normal yield curve where the shorter-term bonds are yielding a much lower amount than the longer-term bonds, and we can see it slowly creeping up, and we get to a point where we're, again, inverting the yield curve, right? We can take a look right here. At this point right now, the 3-month bond is yielding more than the 2-year, 5-year, 7-year, 10-year, 20-year, and 30-year bond. This is a true inverted yield curve, and this is what you're looking to see if you're anticipating a recession. Obviously, if you're like a long-term investor and you just bought, you're like no cash, you have all your money in like super speculative investments, you're not wanting to see this. But if you are anticipating a drop and you have some ammunition, this is a prime chart or prime tool to get an assessment of how the overall sentiment is for the global macro markets, really. Not just for US. I think this is a really good tool for large, like multi-year or at least like a handful of months time frame where you're not going to use this on a weekly time frame, daily time frame, nothing like that. This is like major macro moves that you're looking at, but still really solid, very consistent. And we can see soon after the yield curve inversion, we got the global financial crisis, and since then we had a suppression of the yield curve, so we just had it looking normal for a while, looking normal, and then we see the shorter term bonds start to creep up higher, and then we'll get another yield curve inversion before COVID. Yet again, we can see right here, the 3-month is higher than the 2-year, 5-year, 7-year, not higher than the 10-year. And that is about the most yield curve we're going to see right here is the 3-month being higher in terms of the yield compared to the 2-year, 5-year, 7-year, 10-year. Don't think it's higher than the 20-year, but you do still see a yield curve inversion before the COVID crash. And we did actually talk about this on our YouTube channel if you do go back long enough. And then from there, we had the COVID crash. And we've seen yield curves just remain pretty steady from that point onwards. So, you know, obviously this isn't going to be a black or white tell-all single indicator that is going to guarantee you success in the markets, but it has been very consistent, and you're basically trying to understand what the smart money is doing, what the major funds are doing, not the everyday retail trader that is on crypto Twitter that's saying that it's going to be a bear market imminently because interest rates are going to hike up. This is a lot more of a consensus almost of the smart money in the market, because it's not just an individual, it's the entire bond market that's creating this chart right here. So really cool, really interesting to see. This chart's really interesting as well. So this particular chart has 3 different lines. You have the Chicago Fed National Financial Conditions Index, the St. Louis Fed Financial Stress Test, which we'll talk about, and we'll get into the description of those in a minute. And we have the effective federal funds rate, which is just basically the interest rates that the central bank is able to control. And this green line right here, we can see it's been going to the downside. We already talked about that within here. And then a little bit of information regarding these two stress tests, or the financial condition index and the stress test. So the financial condition index, we can see that right here, provides a comprehensive weekly update on financial U.S. conditions in money markets, debt and equity markets, and the traditional and shadow banking system. The St. Louis Fed financial stress test is a measure. This chart measures the degree of financial stress in the markets and is constructed from 18 weekly data series, 7 interest rate series, 6 yields spreads, and 5 other indicators. Each of these variables capture some aspect of financial stress. Accordingly, the stress levels of the as these levels of financial stress in the economy changes, the data series are likely to move together. So overall, stress in the market, overall conditions of uncertainty and fear is kind of how I look at it. And something really interesting that I kind of looked at when I added these 3 charts together is you do see the inflation, or you do see interest rates rise without much impact in the financial conditions in terms of the stress test or other financial conditions for the Chicago Fed International or National Financial Conditions Index. You don't really see a whole lot of fear and financial worry in these 2 charts while we're hiking up interest rates, which is pretty interesting. It's only when we kind of get to a max interest rate for the current market environment and when we start to see cracks in the economy, that's when the financial conditions start to get really worrying, and you see the financial stress test absolutely spike, and you see the National Financial Conditions Index spike as well. So there comes a point where kind of the structure of how it works is, first, interest rates hike because there is increased inflation. They are worried about the dollar devaluing too quickly. Not a whole lot of worry there. You know, there's a talk about that being not a good thing, but we'll look at the next chart where the S&P still is able to climb while we see interest rates move to the upside. So it's not the interest rates climbing and immediately we see a dump in the markets. That's not really how it's been working recently when you're looking at the historical price action and historical data of these different series of data series here. So what we're seeing is you see a massive spike when you've reached basically max or peak interest rate capability for the economy. And you can see you get these tables, you get these points where the Fed decides, oh shit, we've kind of pushed the envelope too far in terms of the interest rates. Businesses can't afford it, governments can't afford it, individuals can't afford it, and things are starting to break. And once you get that, it's basically a continuous cycle where businesses are contracting and consolidating their assets. They're not spending as much money, which means one man's spending is another man's earnings, or one's business's spending is another business's earnings. So you see earnings go down. People are less inclined to invest because earnings are down. People are pulling money out of riskier investments and putting them into safe investments. It's a self-fulfilling loop. And we can see that this doesn't happen until we start to see the Fed basically push the outer bounds of how high the interest rates are able to go. Because during the initial push of interest rates, we don't really see stock markets take a massive tumble. Like, for example, this is right here, 2017, which is right around, let's say, 2017, May, June, July, August, September, October, November, December, right around here, December 2017. We can see just how far interest rates were climbing. They were very low, and then they climbed a substantial amount. We can take a look at it a little bit later in the next chart. But we can see at this point here, from like, let's say 2016 to the start of 2018, we did see interest rates increase. But what happened during that time? Crypto enthusiasts who've been in the game for a while definitely know 2017 was the top of Bitcoin, just below 20K. So in the last bull run, we already saw interest rates increase. So it's not like it's impossible where we're seeing interest rates increase and it's a guaranteed market tumble. We'll take a look at the next chart here, and we can see this is the interest rates, the effective federal funds rate, and then this is the S&P. This is a really good chart to illustrate. You can see the interest rates increasing, and the stock market, like, this doesn't look like it's increasing that much, but when you actually put it to scale, you know, during that point, you are seeing the stock market rally. Let's just take a look here. 17% in a 762-day period. So not a massive profit, but when you are looking at it from a not-so-squish scale, it definitely puts it into perspective that you can have risk on assets rally while you have interest rates climb. And then same thing, like we already talked about, you have the point where the central banks have like pushed the envelope too far in terms of what the economy can handle for interest rate increases or interest rate payments. And once that hits, there's cracks in the economy. Feds realize that there is more financial stress coming in, as we can see right here, and that creates a self-fulfilling loop when we get into a massive bear market. Same thing here, we see interest rates increase, and this was basically right here, the peak of the previous crypto market bull run, where Bitcoin hit 20K. Hopefully everyone remembers it who was there. It was a wild time. But you can see from, let's say, November of 2016 to December of 2017, just under 1 year, interest rates were increasing. Interest rates went from 0.38 to 1.3. That's crazy. That's more than 3 times. And you can still see that crypto was absolutely booming. So although this isn't a guarantee it'll happen in the future, we're at basically, let's say, 0.25%, 0.1%. We're at very low interest rates. Even if we do climb to, like, let's say 1%, we've had it in the past where we climbed from 0.4% to over, let's say, 1.4%, 1.3%, and we had the biggest bull market in kind of recent history for crypto, right? It's the most memorable one. So don't count out crypto when interest rates are increasing. That's kind of the overall thesis from this particular chart here. And then when you're looking at potential points where they might see some worry, we have seen since the early 80s when Volcker came and raised interest rates substantially, we have been seeing decreasing lower highs on interest rates, which makes sense. Every single time they dip the interest rate low and keep it there and suppress it lower, banks, businesses, governments, individuals borrow cash. And they are assuming that because the interest rates are so low, they're able to just borrow more. And we can see this portion of the timeline here after the global financial crisis was a really bad time because there was a lot of borrowing that was occurring and the interest rates were suppressed for a very long time. So then when there's a lot of borrowing going on, if they raise interest rates, let's say, it doesn't sound like a lot, but 0.5% might not sound like a lot. But then when your interest rates are at, let's say, 0.1% and they raise it 0.5%, that's 5 times the amount of interest that you have to pay. So if you're looking at it in terms of multiples, when you have very low interest rates, it's very hard to raise them again because the multiples of amount that has to increase to get to a certain level is crazy. It's not going from 0.5% to 1% is just, oh, it's 0.5%. You're literally doubling the amount of interest that you have to pay. So if you look at it like that, and if you've seen that the interest rates being basically at 0 since April of 2020, almost a whole year coming to it, it kind of shows you the situation we're in, the predicament that we're in right now, where the Federal Reserve has 2 very difficult choices, or 2 very difficult roads that they have choices to go down. And it's kind of only 2 options. The first option is if they are going to absolutely destroy the dollar, aka inflation, aka potential hyperinflation later on, where they always kick the can down the road. They say inflation sucks, but a bearish stock market is even worse. Basically, we can't let these retirement pension funds go bust. Everyone will lose their money. It'll be absolute chaos. So we will rather steal money from every individual holding US dollars instead of having a stock market crash. That will absolutely destroy the dollar, but that will prevent a stock market collapse. So that's one road that they can go down. The other road that they can go down is basically creating a Paul Volcker type event in the early 80s when they jacked up interest rates significantly, which did curb inflation, but it also restricted the stock market from moving up for over a decade. It was just sideways for over a decade. And if you're actually comparing it to the amount of printing that was occurring, the stock market was a negative yielding asset for a very long time, or a negative yielding index for a very long time. When you account for the amount of printing that was occurring within that time frame, it was actually producing a negative, not yield, but you're actually losing value in the stock market, even though when you're comparing it to the dollar, it's remaining relatively stagnant or overall sideways. So as of this moment, I do not think that we will see a massive stock market collapse the moment we raise interest rates. And if we do raise interest rates, I don't think it'll be as high as like in the 2% range. We'll probably be in like the 1.6, 1.7 before we will. But the main thing we're going to be looking at is not when they raise rates, but when they raise rates and can't raise them anymore. It's a halting of the interest rate hikes because there is uncertainty and because the economy has cracks in the system and the Fed knows it. And once that comes into play and once there's like basically the envelope has been fully pressed, you can't raise interest rates anymore, that is when shit will really hit the fan. But until then, I think it's going to be really good for crypto if they suppress rates and basically just go with the first option where they're going to be devaluing the dollar. It's going to be fantastic for crypto, but make sure for your loved ones, tell them to invest in things that are sound money, invest in things that are going to appreciate. I think crypto is going to be one of them because if you're just holding all your money in cash, you are going to be a major loser and it's going to suck a lot and you're not going to have a whole lot of money by the end of it. So definitely, if you have any boomer parents, grandparents, friends out there that are just careless about financial situations or investments, might not be a bad thing to bring up. So that's going to be the end of this not really global macro update. It's a little bit different. It was a little bit more structured. Hopefully you do enjoy them. If you are enjoying videos like this where we're diving deeper into a particular topic, please let me know. And also, it would really mean a lot and I would appreciate it if we do get a thumbs up and to let us know to continue to make more videos like this. Please hit that subscribe button. Thank you very much for tuning in. Today is January 14th. I'll see you in the Discord and have a good one, everyone.